After studying this module, you shall be able to describe equity financing, identify and evaluate various sources of equity financing, evaluate the advantages and disadvantages of equity as a source of finance, describe debt financing, identify and evaluate various sources of debt financing, and evaluate the advantages and disadvantages of debt as a source of finance. The main aim of a business organization is to produce and distribute goods and services for the satisfaction of needs of society. For carrying out the various activities, the business organization requires capital. It would not be possible for business to function unless they have adequate capital. Raising capital to start or expand the business is the biggest challenge and entrepreneurs face till date. Broadly speaking, financing capital can be availed from two sources: equity or debt. Let us now study about different sources of equity financing. The different sources of equity financing are: first, one is personal saving, second is family members and friends, third is business angels, fourth one is venture capital, and the fifth and the last one is going public. Let us discuss each one of these in detail. First is personal saving. The easiest and the least expensive medium to raise startup money for an entrepreneur is his own pocket. The sooner the entrepreneur takes outside money, the more ownership he will have to surrender. Moreover, investors and lenders expect entrepreneur to put his own money in business venture. If the entrepreneur is unwilling to risk his own money, then the potential investors are unlikely to risk their money in the venture. Furthermore, if the entrepreneurs fail to put in sufficient capital by his own means, he will have to borrow excessively or give a significant portion of ownership to the third-party investors so that the business can function. Borrowing excessively puts a lot of pressure on the cash flow of the business, and becoming a minority shareholder may have a negative impact on the enthusiasm of the entrepreneur. Moreover, the cost of debt also burdens heavily on the profit position. All the above mentioned outcomes can dampen the future of the business venture involved. Second is family members and friends. Only a few entrepreneurs have sufficient resources to raise the funds required to start the venture. After they have utilized their personal savings, the entrepreneur looks at family members and friends who might be willing to invest in business venture. Investments from friends and family are the most effective way of raising seed capital for the venture so that it establishes itself enough so as to attract funds from venture capitalists and angel investors. Furthermore, these investors, because of the personal relationship they share with the entrepreneur, are more patient and less meddlesome in the working of the business than outside investors. However, the entrepreneur should treat family members and friends who invest in the business in the same way they would treat their business partners by honestly presenting the investment opportunity and the nature and amount of risk involved. Third is business angels. Business angels are high net worth, non-institutional, private equity investors, often entrepreneurs themselves, who have the desire and sufficient high net worth to enable them to invest part of their assets in high risk, high return entrepreneurial ventures in return for a share of voting, income, and ultimately capital gain. Funding from angel investors is generally the first round of external investment. In fact, it is the largest source of equity financing for ventures in the seed and startup phase. These investors normally invest in the early stage of the venture when the promoters have exhausted their personal savings and sources of funding from family and friends, thus filling the gap in startup financing between family and friends and formal venture capitalists. Some business angels often invest on their own, while others invest as a part of some syndicate network or investment club. Unlike venture capitalists who invest pooled money of others, angel investors invest their own. Moreover, many angel investors invest for reasons other than economic, such as their personal interest in a particular industry or experience. Some business angels are experienced entrepreneurs. They bring their knowledge, skill, set and contacts along with the money for the venture. Angel investors bear extremely high risk since there is a high possibility of venture failing in the startup stage and are usually subject to dilution from future investment rounds. Moreover, they act as an excellent source of patient money as they are willing to wait 7 years or longer to cash out the investment made by them. They earn return on investment to increase in the value of business rather than dividend and interest. Fourth is venture capital. Venture capital companies are private, for-profit organizations that assemble potential producing annual returns of 200 to 500% within three pool of money and then use it to purchase equity of businesses they believe have high growth and high profits to 7 years. Venture capitalists act as intermediaries as they pool money from a number of investors and then make equity investments in portfolio companies. They invest in companies that are in early stages of development or in rapid growth stage. Also, venture capitalists do not make a single investment in a business venture, rather they invest in a venture over time in several stages. Venture capitalists normally let the founding team managers employ their skills if they feel they are capable of managing the growth of the business. However, they join the business venture as board of directors. Majority of the venture capitalists take an active role in managing the affairs of the company, right from recruiting employees to providing sales leads and choosing advertising agencies. The screening process by which the venture capitalists decide on the venture to be financed is quite rigorous and involves a number of steps. They invest in less than 1% of the applications that they receive. Typically, a venture capital company purchases 20 to 40% stake in business, but in some cases, a venture capitalist may purchase 70% or more of a company's shares, leaving its promoters with a minor share. Venture capital companies also lay importance on the exit strategy to be adopted. They generally realize the return when the business venture they have invested in goes public or the venture is acquired by another business. Fifth is going public. Entrepreneurs go public by selling shares of stock in the venture to outside investors. In an initial public offering, that is IPO, the business venture raises capital by selling the shares of the company for the first time to the general public. This is the most effective method of raising large amount of funds, especially when all the other methods of raising capital have been exhausted. However, it is an expensive and time-consuming process involving a number of regulations to be complied with. Coming out with a public issue gives a boost to the net worth of the business venture and expands the equity base of the venture. And it enhances the financial strength of the venture, making it easier for the business to attract more capital in the future, whether in the form of equity or debt. The venture has a large amount of funds which can be used for expansion, modernization, funding, research and development projects, boosting the working capital balance, repaying the debts of the firm, hiring and retaining competent employees, etc. Going public enhances the corporate image of the business venture as the registration process makes the venture more visible. Moreover, being a public company brings prestige to the venture and enhances its competitive position. However, when the entrepreneurs go public, they dilute their ownership in their venture. Though they retain majority stake in the business, but going public increases the profitability of an unfriendly takeover. The entrepreneur cannot take major decisions without the consent of the stakeholders. Also important information that was privately held by the entrepreneurs can no longer be held privately and are available for public scrutiny. Loss of control and loss of privacy are the two biggest disadvantages of going public. Let us now look at the advantages of equity financing. The biggest advantage of raising capital through equity is that the venture is not bound to repay any amount. The investor buys a portion of the enterprise and gets a proportionate share in the profits of the business. The investors have the option of selling their shares when they wish to exit. The external investors, by acquiring the shares of the venture, not only become part owners of the company, they also share the profits and losses of the company, thereby limiting the promoter's loss and protecting the company during the economic downturn. The high equity base has a positive impact on the credit rating of the company, as it implies that the company is backed by a number of investors and has sufficient funds to pay off its creditors. By raising capital through equity and listing the company on the stock exchange, the promoter as well as other investors can offload their holdings to other interested investors and quit the company without shutting down the business. Third-party investors in the form of venture capitalists and angel investors bring valuable skills, experience and contacts for the venture. They also provide assistance in the decision making and strategy formulation. After studying advantages, let us now move over to look at the disadvantages of equity financing. Raising funds through equity leads to dilution of control of the original promoters. If the promoter is not able to match the investment made by third-party investors, then there is a chance of other investors acquiring more than 51% of the shares and forcing the original promoter to get out. With equity financing, the original promoter's decision-making power is drastically reduced as all the investors will have a say in the working of the enterprise. All the investors of the enterprise need to be consulted before any major decision is implemented. Moreover, the external investors have a right to question the management regarding any aspect of the business venture. Raising capital by taking the equity route is a time-consuming and costly process. There are a number of legal and regulatory issues to comply which requires strict adherence. Moreover, potential investors require comprehensive background information which takes up valuable time, energy and resources that can be better utilized in performing the core activities of the business. Raising funds through equity leads to a permanent obligation as investors have a right to stay put and take their cuts of profits forever. Let us now study the concept of debt financing. Debt financing refers to the process of raising capital by borrowing money from investors or lenders with the promise to repay it with interest in the future. Business ventures that employ debt financing as a mode of raising funds accept a direct obligation to repay the funds within a certain period of time. In a way, lenders become creditors of the venture. The rate of interest that is charged by the lenders on the fund borrowed reflects the risk that the lender is willing to undertake by providing money. In debt financing, generally there is no provision for ownership in the business venture, although there are certain forms of that can be converted into stock. In case of liquidation of the venture, lenders or borrowers are paid off before the owners, thereby making it less risky in comparison to equity financing. It is a suitable option for ventures having stable history of revenue, cash flows and earnings and good credit rating. Debt can broadly be classified into secured debt or unsecured debt. Secured debt refers to debt that is secured by some collateral to minimize the risk of the lender. The lenders have recourse to the asset of the venture on a proprietary basis. If the business venture continuously defaults in making payments, the lender has the option to sell the assets, mortgage and recover the money. Whereas unsecured debts refers to the debt in which the lenders are not provided any asset as collateral. The lenders do not have recourse to the assets of the venture, thus making it risky for the lender. Unsecured debt is normally provided at high interest rates to cover the risk of default. Now, let us look at the sources of debt financing. First is commercial banks. A commercial bank is a type of bank that provides services such as accepting deposits, offering investment options and providing loans to businesses as well as individuals. Commercial banks are the easiest option for small businesses to raise funds. However, commercial banks are conservative in their lending practices. They prefer granting loans to established businesses with good credit history as compared to businesses in the early stages of development. Bankers often want to see evidence of ventures' track record before committing funds. They scrutinize the firm's past operations and financial reports to predict how they will behave in the future. They also analyze the venture sales and cash flows to ensure that the business is earning sufficient money to repay the loan along with the interest. For businesses in the startup stage, apart from sufficient fund flows, they also look for assets as collateral. These days, commercial banks offer a variety of options to businesses such as flexible repayment terms, interest rates varying with seasonal cash flows of the ventures, etc. However, such options are limited to only established businesses. The loan provided by the commercial banks can be short-term and long-term. Short-term loans. The short-term loans are the most common type of loans provided by commercial banks and are extended for a period of 1 year or less. These funds are used by the businesses to take benefit of cash discounts or to replenish their working capital. These loans are normally repaid after the inventory and receivables are converted into cash. Short-term loans can be in the following forms: commercial loans and lines of credit. Commercial loans are the traditional types of loans provided by commercial banks normally to finance specific expenditures of businesses, such as to purchase a particular machine or equipment. These loans are repaid within 3 to 6 months in lump sum. Commercial loans could be secured as well as unsecured. Secured loans give the banker security in case of default on the part of business, but they are difficult to administer. Unsecured loan is provided only to those businesses that prove their financial strength to the banks. Lines of credit is a form of credit extended by banks to credit-worthy businesses through which businesses have access to funds at their discretion quickly and conveniently. The banks provide loans with a predetermined ceiling that helps in solving the liquidity problem often faced by the entrepreneurs. The entrepreneur can borrow money up to a preset limit by writing him a loan anytime during the year to meet the shortage in the cash flows. The interest is charged only on money that is actually withdrawn and not on the limit that has been set. However, businesses need to pay a small handling fee along with interest, which is normally around 1 to 2% of the maximum amount of credit. Line of credit can take a number of forms such as demand loans, term loans, overdraft protection, export packing credit, revolving credit card account, etc. Long-term loans. The loans provided by commercial banks to businesses for a period of 1 year or longer are classified as long-term loans. Banks normally issue long-term loans with a collateral. These types of loans are availed by the businesses for long-term investments such as expanding the businesses, purchase equipment, etc. The repayment towards the loan is made in monthly or quarterly installments. The most common type of long-term loan issued by commercial banks is term loan. Term loans are normally granted to the companies with high credit worthiness. Certain commercial banks issue loans only with a collateral. The banks impose a number of restrictions on businesses such as the salary of the promoters, maintaining certain financial ratios, or imposing restrictions on further borrowings without the approval of the bank. Non-bank sources of credit. Commercial banks are the first stop for business ventures looking for debt. However, there are other sources of debt capital that can be tapped by the entrepreneurs. Financial institutions. A number of financial institutions, also called as development banks, have been established by the government, such as IFCI, that is Industrial Financial Corporation of India, or SFC, that is the State Financial Corporation, and IDBI, that is Industrial Development Bank of India, etc., to provide finance to the entrepreneurs. These institutions not only provide loans to meet the medium and long-term requirements of the venture, but also conduct market surveys for them, along with providing managerial and technical assistance. Entrepreneurs generally approach financial institutions when huge amounts of funds are required for expansion, modernization, or even reorganization of the venture. Raising capital from financial institution has a positive impact and the goodwill of the business venture and makes it easier for it to raise funds in the future. Moreover, the loan can be paid in easy installments, making it very convenient for the venture. However, raising funds is a tedious task as a number of formalities have to be complied with. Also, financial institutions impose certain restrictions on the venture, such as restricting the dividend to be paid. Trade credit. Trade credit is an extremely important source of financing available to young companies and refers to credit provided by one trader to the other. When banks are unwilling to provide funds to new entrepreneurs or ventures in early stages of development due to high credit risk, entrepreneurs turn to their vendors for capital. A trade credit facilitates the purchase of supplies without immediate payments and is granted to those ventures that have a reasonable amount of financial standing and goodwill. The amount of credit extended often depends upon the financial position of the venture, past record of payment, credit worthiness of the venture, and the degree of competition in the industry. The biggest advantage of trade credit is that it does not create charge on the assets of the venture. However, only limited amount of funds can be raised through it. Asset-based lenders. Asset-based lenders consist of commercial finance companies and small commercial banks that provide loans to businesses by pledging assets that are lying idle, such as inventory accounts, receivable, or purchase order as collateral. This method of procuring funds is popular with wholesalers, distributors, and manufacturers. New businesses or unprofitable companies for whom raising capital from commercial banks is difficult often get loans from asset-based lenders. The most common types of asset-based financing are inventory financing and discounting accounts receivable. Now, what is inventory financing? The business raises funds through raw material, work in progress, and finished goods. If the venture is not able to repay the loans, the lenders can claim the pledged inventory and sell it. Since it is difficult to determine the value of inventory, lenders normally are only willing to pay 50% of the inventory's value. To avail inventory financing, the businesses are required to prove to the lenders that they have a plan in place to ensure that the inventory that is used to secure the loan sells quickly. Discounting accounts receivable. The business venture pledges its accounts receivable as collateral to the lender, who in turn advances loan. However, the amount of loan is not equal to the face value of account receivable pledged. Usually, a venture is able to borrow 55% to 80% of the face value of its receivable. Let us look at the advantages of debt financing. Through debt financing, maximum utilization of resources take place. When an organization uses debt to finance the operations of the venture, they need to fully utilize the resources, as they have an obligation to repay the debt along with interest. Debt financing is an effective way of raising funds for short-term needs. Businesses can directly approach a bank or financial institution to meet its short-term needs. Moreover, debt financing is easy to administer and less expensive in the long run. Debt financing gives the business venture a tax advantage. For calculations of tax, the interest paid by the venture towards the borrowings is tax deductible, hence providing the venture some kind of tax relief. The lender does not become the owner of the business and has no direct claim on the future earnings of the venture. Moreover, lenders do not have a say in the working of the business. The entrepreneurs are free to take decisions without interference. Thus, the entrepreneur retains ownership and control in the business, as well as maximizes its earnings by paying fixed rate of interest. Debt financing gives the business owner more financial freedom in comparison to equity financing, as the debt obligation is limited to a fixed period. Once the payment has been made, the lender has no claim on business, whereas in equity financing, the investor's claim in the company does not come to an end until they sell the shares. Looking at the disadvantages of debt financing. It requires the entrepreneur to make monthly payments towards principal and interest on a regular basis. Mostly, business ventures during the startup and growth phase experience a shortage in the cash flow, making it difficult for the venture to make regular payments. If the venture defaults in making the payment, even temporarily, it can adversely affect the credit rating of the business and have a negative effect on its ability to obtain funds in the future. Lenders look for security for the funds provided by them, making it difficult for new ventures to obtain loan. Moreover, if lenders give loans to new ventures, they generally charge high rates of interest or take collaterals. Let us now summarize what we have learned in this module. In this module, we learned that an entrepreneur has two main sources of raising capital, that is equity and debt. Equity financing refers to the process of raising capital by selling the shares of the business to external investors. Source of equity financing can be personal saving, family members and family, business angels and venture capital. The biggest advantage of raising capital through equity is that the venture is not bound to repay the amount, as equity providers are the owners of the company. Equity financing leads to dilution of control of the original promoters and also reduces their decision-making power, as the investors need to be consulted for all important decisions. Debt financing refers to the process of raising capital by borrowing money from investors or lenders with a promise to repay it with interest in future. Debt can be broadly classified into secured debt and unsecured debt. What are the sources of debt? Commercial banks and non-bank sources of finance, that is financial institutions, trade credit or asset-based financing. While debt financing helps business ventures meet its short-term financial needs and also helps them get a tax advantage. Business ventures that employ debt financing as a mode of raising funds accept a direct obligation to repay the funds within a certain period of time. If the venture defaults in making the payment, even temporarily, it can adversely affect the credit rating of the business and have a negative effect on its ability to obtain funds in the future.